Welcome to the 2023 Economic Preparation and Depression Channel. I'm your host, Tony. Thank you for joining me on this June 20th, 2023. Tomorrow's the first day of summer, and stocks are going into a slump. So we're just going to talk about that briefly, as well as the strong dollar and how is it going to be weakening as inflation and spending starts to decrease on a lot of projects coming up this coming year and later on in the fall. Please be sure to subscribe. I thank you for your support. Stocks closed lower, according to CNBC, for a second straight day. Dow Jones sheds 200 points as the market rally cools. The Dow Jones fell by 245 points, down to 34,053.87. The S&P 500 slid down almost a half a point, and the Nasdaq Composite declined of a 15th of a point. Markets were closed yesterday due to the Juneteenth holiday. Now we're back open on Super Tuesday, and things are going downhill and going downhill fast. But home builders said they had a stronger than expected housing report back in May. Each was up about 2%. Pulte, D.R. Horton, and Lennar Homes are up a couple of percentage points there, and investors were coming off a strong week with the S&P hitting its highest level since April 2022. So now we're in a situation now in the summer where, remember, we haven't had any boost of a stimulus check in the last year and a half. And we haven't had much money printing except to bail out the SVB Bank, Signature Bank, and other banks, crypto banks that have failed and been consolidated technically into the mainstream banking system. So now we have a situation where the stock market is sliding ever so slightly. Will it continue? Well, that depends on the dollar, the fate of the dollar. Okay, how will the Federal Reserve's rate hike pause affect the dollar? Other countries know that we've been printing money. They know that there are other central banks, the European Central Bank, the Australian Central Bank, the German Central Bank, the England Central Bank. All of these banks have been raising interest rates, but now the U.S. Federal Reserve has issued a pause on the rate hikes after hiking it 10 times in a row. So this means that a strong dollar, quote unquote, will affect prices, tourism, and trade. Now, if we have a weaker dollar, okay, that will be the opposite effect. Now, a strong dollar directly impacts the cost of importing goods. So if you have products made in foreign countries, such as Walmart, countries that they do that, they produce a lot of goods in China, Malaysia, Thailand, Brazil, stuff like that. Even as the United States experiences inflation, these products stay relatively cheaper. Quote, one of the underappreciated dimensions of a strong dollar, quote unquote, is that it weighs on inflation, she said. This is what one of the top investment strategist, Lisa Shallett, he said at Morgan Stanley. But there are downsides to the dollar's strength. He said U.S.-made goods look more expensive in comparison to cheaper imports, reducing U.S. exports. So in other words, we're importing a lot of stuff, over 75% of our goods and services. We're not exporting a lot of stuff, maybe 25% of our goods and services. So U.S. is not producing as much as we've been saying on this channel for a long time, and you guys know that, ladies and gentlemen. That's not the only way, but a strong dollar can hurt American workers and businesses, according to Gannon. While Americans find trips abroad relatively cheaper, tourism to the United States may take a hit. And it makes it more expensive for foreigners to come to the United States, which reduces demand for U.S. restaurants, hotels, and attractions. So all of those American-made businesses are going to be taking a hit because not too many people are going to be coming here. They're going out of the country to vacation, of course, in the Caribbean and Mexico and Asia and Africa and Europe. They're not coming here because, they're not getting no bang for their buck, the dollar, okay? So the dollar is usually considered a safe haven currency for its perceived quote-unquote stability. According to the Federal Reserve, it's the most used currency in foreign transactions. It's the least sickest child in the hospital right now, the dollar. But now, if the U.S. economy doesn't bear strong, which it won't be strong going into this next election year, as you all know, the dollar becomes weak. We're going to be printing up more money. The purchasing power of the dollar is going to go down. The stock market is going to be the last cookie to fall in this whole piece of the puzzle. Remember, we still have three markets left to fall. We have the credit market, the commercial-backed mortgage security market, the housing market too. That's combined. And then we also have the market of the consumer confidence. Okay, that means U.S. confidence, how confident we are in the dollar thing. So Wall Street doesn't expect the dollar's rally to continue forever, though. Goldman Sachs recently said it estimates a bumpy downside for the dollar in the second half of this year into 2024. So they're already anticipating, these big banks are already anticipating a weakness or a softness, right, in the dollar status. Not all experts agree that the conditions are ripe for a weaker dollar just yet. I don't see anything on the horizon that will weaken the dollar, Gannon said, but in the long term, quote, several developments could challenge the U.S. dollar supremacy. What are those conditions? The article doesn't mention it, but we know on other channels that we've seen, such as Kitco and Al Jazeera and other international channels, that is the BRICS currency, the Brazil, Russia, India, China, and other developing nations currency that they're working on developing, that's going to challenge the petrodollar. Remember, the dollar is used to trade oil. And once that happens, ladies and gentlemen, and maybe this year, maybe 5 years from now, that's going to challenge the U.S. dollar supremacy in terms of using it as a worldwide currency. And when that happens, all of these dollars that these other countries are trading is going to come flooding back to United States shores, creating hyperinflation that many fear and that many economists have been talking about. And then that's it. The system collapses. We start a reset. Some people will get a debt jubilee, quote unquote, that people have been talking about. Other people won't get that. And then, but one of the questions I do have for anybody out there, what happens to all of the debt denominated in dollars, like the U.S. mortgages, U.S. commercial-backed securities, T-notes, treasury bills? What happens to all of that if we go to a great reset? And that's one of the questions that I think was answered by the World Bank and IMF paper. I have not yet seen it yet, or read it yet, I should say. But that's going to be a big question, is what happens when we go to the great reset, whether it's 5 or 10 years from now. What happens to all of those debt-denominated notes that just reset? And what happens to our $32 trillion of unfunded liabilities of debt, and $32 trillion of debt that we had that leads the world in U.S. dollars? So that's going to be something to look forward to. And then in the new currency, what's going to happen in the new currency when all these countries switch to the new strongest currency after the dollar? What's going to happen? How are we going to trade? Is going to be more of a black market thing? Is going to be a central bank digital currency, a CBDC, as everybody talking about? One thing for sure is that all these banks around the world, Bank of England, the European Central Bank, the Australian bank, the German bank, the Japan, all these banks are doing the same thing. Okay, they're either pausing like the U.S. Federal Reserve, or they're raising rates just to get ahead of this hot hyperinflation storm. CNBC says Bank of England's conundrum deepens as inflation in the labor market stays hot, quote unquote. So even in England, and even in in Germany and Romania and Italy, okay, Greece, Albania, all these countries have inflationary pressures on their currency in everyday life. So the Bank of England is trying to get ahead of this storm as they're caught between a rock and hard place as it prepares for a key monetary policy decision of sticky inflation in a tight labor market. So right now, England and the U.S. pretty much follow tandem. The difference between our economy and theirs is that we don't have a hot labor market right now. Our labor market is starting to level off. Initial jobless claims in America rose, and continuing jobless claims remain about the same. But in England, they're saying that they have a hot labor market and everything, and so they can anticipate more rate hikes there, according to Goldman Sachs and other international economists. So because of that, we're going to be mirroring the same thing, but this is going to happen to us later in the fall and in this year and into winter time. Okay, when our labor market starts to cool off or heat up, depending on how you look at it, then they're going to start to continue the rate hikes. The question for most economists here is, and the question for you, ladies and gentlemen, is, when do you think the Federal Reserve Bank will continue the rate hikes? Is it after next year, after Christmas next year, at the beginning of next year, 2024, or will they continue hiking rates on the next meeting in July? That is the big question, ladies and gentlemen. Let me know what you think down in the comments. Thank you for listening. Please be sure to subscribe to this channel for the latest interpretation of financial news, and I appreciate your support. Thank you very much.